Priya bought a duplex at 28. Her co-worker Daniel put the same money into an index fund and went back to watching Netflix. 20 years later, one of them is stressed, exhausted, and worth more money than they expected. The other one barely thought about money at all and ended up in almost the exact same place. The problem isn't which one chose wrong. The problem is neither of them chose with the full picture. And the full picture is the only thing that actually matters. Let's set the stage fairly. Priya and Daniel are both 28. Both earn $62,000 a year. Both have managed to save $45,000, a number most people their age never hit. They're not lucky. They're disciplined. The question is what discipline looks like when applied to two completely different strategies. Priya uses her $45,000 as a down payment on a $225,000 duplex, a 2-unit property where she plans to live in one unit and rent out the other. She takes out a 30-year mortgage at 6.75% interest. Her total monthly mortgage payment is $1,170. The tenant in the second unit will pay $1,100 a month in rent. Do the math on day one, and it almost covers itself. She's essentially living for $70 a month in housing costs while building equity in an asset she owns. On paper, this is one of the most powerful wealth-building moves a 28-year-old can make. Daniel puts his $45,000 into a total market index fund. He automates $250 a month from his paycheck. He reads one book about investing, decides he already knows enough, and moves on with his life. His co-workers find out and nod politely. Nobody asks him about it again. On day one, Priya has a property, a tenant, and a plan. Daniel has a confirmation email, and a Saturday with nothing to do. The first 2 years are Priya's favorite chapter of the story. Her tenant pays on time. The mortgage practically pays itself. She's building equity with every payment, claiming depreciation on her taxes, and watching comparable duplexes in her neighborhood sell for more than she paid. She tells her parents. They're proud. She tells her friends. They're impressed. She posts a photo of her property on Instagram and gets 200 likes. Daniel's portfolio hits $55,000. Nobody cares. But here's what year 3 looks like when you actually open the books on Priya's investment. Her unit has been vacant for 6 weeks between tenants. That's $1,650 in lost rent. She paid $800 to repaint and clean. She replaced a water heater in her tenant's unit. $1,350 out of pocket. Her property taxes came in at $2,700 for the year. Insurance runs $1,400 annually. She spent 11 weekends in the past year doing showings, coordinating with a plumber, reviewing lease applications, and handling a noise complaint from a neighbor. Her actual net cash flow over 3 years, after every real dollar that left her account, is somewhere between $1,500 and $3,500. Not the $1,100 a month her friends think she's pocketing. And that doesn't include a single hour of her time. Daniel's portfolio, with contributions and roughly 10% average annual returns, is sitting at about $68,000. He used that free time to take a weekend trip to Colorado. Now, before this becomes a stocks always win video, because that would be just as misleading as the other side, let's be honest about what Priya actually has that Daniel doesn't. She used $45,000 to take control of a $225,000 asset. That's 5-to-1 leverage. When her property appreciates 3 to 4% a year, she's not gaining 3 to 4% on her $45,000. She's gaining 3 to 4% on $225,000. That's the part no stock market spreadsheet captures cleanly. By year 3, her property is worth roughly $245,000 to $255,000. Her equity, what she owns after subtracting the mortgage balance, has grown to around $52,000 to $60,000. That came partly from her payments, partly from the market, and partly from the bank's money doing work she didn't have to do. That's real. That's powerful. And Daniel simply doesn't have access to that mechanism. Without margin accounts, most people should never touch. Let's talk about what actually drains real estate investors that nobody puts on a YouTube thumbnail. Turnover costs. Every time a tenant leaves, You're not just filling a vacancy. You're deep cleaning, repainting, possibly replacing carpet or fixtures, relisting, screening applications, and running background checks. The average landlord spends between $1,000 and $3,000 per turnover. Multiply that by 3 or 4 turnovers over 20 years, and you're looking at $5,000 to $12,000 that never appeared in the original cash flow math. Capital expenditures, roofs, HVAC systems, water heaters, appliances. These don't break on a schedule. They break when you least want to spend money. When a tenant calls at 7 p.m. on a Friday, when you're about to leave for vacation, when your emergency fund is already stretched. On a $225,000 property, budgeting $2,000 to $4,000 per year for CapEx is conservative. Some years it's nothing. Some years it's a $9,000 roof. The time cost. Priya manages her property herself to avoid the 8 to 10% management fee. That would run her around $110 to $130 per month. She doesn't have to give away. But self-management isn't free. It costs time. Evenings, weekends, mental bandwidth, if her time is worth anything. And it is. That calculation changes the real return on her investment. And then there's a risk nobody prices in until it happens to them. One bad tenant who knows how to delay an eviction can cost you 3 to 5 months of lost rent, $1,500 to $3,000 in legal fees, a unit that may need significant cleanup when they finally leave. That single event can erase an entire year's profit. Sometimes more. By year 7, Priya has had 3 tenants. She replaced the HVAC unit for $5,800. She dealt with a water leak that damaged drywall, $2,200 in repairs. She raised rent to $1,250 and then to $1,350 as the market moved. Her cash-on-cash return, the actual money she pockets relative to what she put in, is running around 4 to 6% after everything real. Not bad. Not the number she quotes at dinner parties. Daniel now has a portfolio worth roughly $120,000 to $135,000. He hasn't panicked. He hasn't sold. He went through 2 market pullbacks, and both times the number went back up. His money is now compounding on itself. The gains generating gains. The curve began to bend upward faster than it did in year 1. At year 10, here's the honest snapshot. Priya's duplex is worth approximately $300,000 to $315,000. Her remaining mortgage balance is around $155,000. Her equity sits at roughly $145,000 to $160,000. Her total out-of-pocket costs beyond the down payment, the repairs, the vacancies, the capital expenditures, are somewhere between $25,000 and $40,000 over the decade. Daniel's portfolio, with consistent $250 monthly contributions and 10% average annual returns, is sitting at approximately $155,000 to $170,000. He put in $45,000 upfront and $30,000 in contributions. The remaining growth is pure compounding. They are nearly even in total wealth at year 10. But how they got there is completely different. Priya worked for her number. Daniel waited for his. Priya has one asset in one city on one street. Daniel holds a slice of thousands of companies across every sector and country. This is where the 2 paths finally split wide open. By year 20, Priya's duplex is worth somewhere between $390,000 and $430,000. Her mortgage is either paid off or within a few years of payoff. Her equity is approximately $370,000 to $430,000. Over 20 years of cash flow, rent collected minus every real cost, mortgage interest, taxes, insurance, maintenance, CapEx, turnover, vacancy. Her net profit from the rental income itself might be $50,000 to $90,000. In a strong market, maybe more. In a flat one, less. She also lived in the other unit for several years and paid almost nothing in housing. If you assign a dollar value to those years of reduced rent, say $600 to $800 a month in effective savings, that's another $50,000 to $80,000 in economic benefit that never shows up on a cash flow statement. That's the house hacking advantage that doesn't exist anywhere else. Daniel's portfolio at year 20, with $250 monthly contributions and 10% average annual returns, is sitting at approximately $380,000 to $420,000. Total contributions over 20 years, $105,000. The other $275,000 to $315,000 is pure compound growth. No debt carried. No calls about broken pipes. No turnovers. No weekends lost. They both built somewhere between $400,000 and $500,000 in net worth over 20 years, starting from the exact same number. But ask them how they feel and you'll get two completely different answers. Priya will tell you she's proud. She'll tell you real estate made her feel in control. She'll tell you having something tangible, something she could drive past, manage, improve, kept her engaged with her wealth in a way that a brokerage account never could. And she'd be right. Daniel will tell you he never lost a night of sleep over his money. He'll tell you that during the 2020 crash, he didn't look at his account for 3 months and came out fine. He'll tell you the freedom to move cities, change jobs, or spend a year abroad without worrying about a property was worth more than any return difference. And he'd be right too. Here's the part that changes the math for both of them. If Priya had bought a straight rental property instead of house hacking, her housing costs would still exist. She'd be paying rent or a mortgage somewhere else. That expense cancels out a significant portion of the rental income she's collecting. The house hacking model is what made her strategy genuinely powerful, not just real estate in general. And if Daniel had added just $150 more per month to his contributions, bringing it to $400, his 20-year portfolio jumps to roughly $480,000 to $530,000. Compounding rewards contribution size in ways real estate simply can't match without taking on additional debt. So what actually wins? Real estate wins when the rent-to-price ratio works in your favor from day one. The general benchmark is monthly rent at 0.8 to 1% of purchase price or higher. On a $225,000 duplex with $1,100 in rent from one unit, Priya is right on the edge. In markets where that ratio is stronger, real estate can significantly outperform. Real estate wins when you house hack. Using your investment to eliminate your own housing costs changes the entire return profile. It's not just an investment. It's shelter that pays you back. Real estate wins when you scale. One property is a job. 5 properties with a property manager is a business. The investors who build real generational wealth from real estate rarely stop at one. Index investing wins when consistency beats complexity. The biggest advantage isn't the 10% average return. It's that 10% average return never requiring you to do anything. No decisions under pressure. No emergency fund for repairs. No single asset concentration risk. Index investing wins when you stay invested. The data on retail investor behavior is brutal. The average investor underperforms the index by 1 to 3 percentage points per year because they react to market news, sell during crashes, and buy back in late. The investors who match the index return are the ones who do exactly nothing. Index investing wins when flexibility matters. You can sell $500 of an index fund in 4 clicks. Try doing that with a house. The real trap in this entire debate isn't real estate. It isn't stocks. It's making the decision the way most people actually make it, based on a video they watched, a podcast clip they heard on a commute, or a conversation with someone who made money and now believes they've discovered something the rest of the world is missing. Priya didn't make a mistake. Daniel didn't either. They both made a commitment and stayed with it through the boring, uncomfortable, unremarkable middle years when nothing felt like it was working. That's the part nobody makes a video about. Because I kept contributing every month for 20 years and didn't panic sell doesn't get 1.3 million views. But it might be the most financially important sentence you hear all year.